We're seeing continuous pressure on the markets as gold and the S&P 500 are seeing downward action. Phil Streible, Chief Market Strategist at Blue Line Futures, is back with us to dissect market action. We're speaking with Phil as of 11:30 a.m. Eastern Time on Friday. Phil, welcome back. It's hasn't been a terribly volatile week per se, but we are seeing pressure, as I stated. How are you reading the markets? I know we spoke on the phone just now. You told me you are short-term short on gold. Is that correct?
Yeah, we've been playing the downward channel in gold, and especially with the acceleration upwards in interest rates again today, specifically on 10-year yield, 30-year bond yields. Those have broken back out to the upside. Every time we see that happen, what happens is you get a spike in NASDAQ volatility. You get these wild moves in the U.S. equity markets. They have a spillover effect on the gold and some of the precious metals. So it seems like much of the movement that we're seeing in metals is more emotion-driven and interest rate driven at the moment. And when we get close to a $1,700 level, of course, you're going to have that psychological number come into play.
I have to ask, Phil, it seems that the bond yields are sort of a threat to both the equities markets and the precious metals markets right now. So what's driving the yields higher?
So, well, yields naturally are going to rally with rising inflation. Now, certain sectors of the market don't respond well, and others do respond well when you do have a rising yield. Say financials, for instance, fantastic area to be in a rising yield environment. Gold, on the other hand, does not perform well because of the fact that many people hold it as a safe haven asset. They'll allocate into something that does give them a yield and some safety, which is the bond market.
Okay, I'd like to draw your attention to this chart now. It shows the GLD ETF versus the TIP ETF. I've showed this chart on the show a couple times before. I really like this chart because of all the variables I've observed, the GLD ETF, which tracks the gold bullion, has the closest correlation with the TIP ETF. The correlation coefficient is 96% if you look at it from a 5-year time horizon. So on this chart, you'll see that the yellow line represents the GLD ETF and the blue line represents the TIP ETF, which tracks inflation expectations. The Treasury Inflation Protection Security goes up when inflation expectations in the marketplace goes up and down, vice versa. What you've seen in the last couple of months is that the GLD ETF has trended downwards, while the blue line, the TIP ETF, has maintained its sort of height. So there is a bit of a divergence for the first time in 5 years. Why do you think this has happened?
It's an excellent observation by you too, David. I want to point out that typically they do correlate together because gold has historically been a great asset class for inflation. That's where you get the people that present their ideas that are like over 10, 20 years and things like that. So they're looking at that longer term chart. However, when all asset classes and specifically commodities basically went to unprecedented lower levels, things like lumber, crude oil going negative, everything from your grain markets, copper, everything just got smashed about 1 year ago today. Those were at this new baseline level that as you see demand increase and as things pick up, those price of those specific commodities had really taken off to the upside. So people found a lot better ways to play inflation just by going specifically into the pure commodities like lumber, oil, gasoline, things like that, and avoiding non-yielding commodities, specifically gold.
Okay, so are you saying that gold is, I guess, replaced by the market as an inflation hedge, and there are better instruments out there? Am I interpreting the comments correctly?
Yes, exactly. And the fact that many people, received stimulus checks and things like that over the course of the last year, they took that money and they deployed it in different asset classes, things like Bitcoin, Ethereum, and chasing these other assets that are out there, whether it be stock indices. We talked about, some of these smaller stocks just going to unprecedented levels again. So it was really, money came into the market, it was chasing inflation, but it was chasing different ideas out there where normally the concentration would be held in like gold and silver.
Okay, you brought up some other commodities like lumber and crude oil. I know you track crude oil. Tell us about oil. Energy is sort of the foundation of our entire our economy rather. So if oil goes up, and in fact, let's assume it goes out of control, that could really have a huge impact on our overall inflationary environment, couldn't it?
So the oil was really the reopening play because of the fact that it's cracked into gasoline and bunker fuel and things like that, heating oil. So it's used for a lot of different transportation type vehicles. And what happens is as vaccinations occur, number of cases go down, people start to get mobile. And I think they really did right around Thanksgiving to Christmas. They realized that they can go out a bit and they are starting to travel more. So the demand for oil has been continuing to increase. The interesting thing about it, though, is that oil prices, we've really given control over to OPEC on where oil prices are going to go. So the play was already in place from November till now. We're breaking out to new recent highs. But the reality is that once we get closer to like June, July, and prices get in the 70s, you're going to see Saudi Arabia start pumping oil out and oil prices will back off. So I don't think, you're going to see that $90, $100, $110 oil. I just don't see it happening because OPEC has too much supply that they can provide with demand only inching higher.
Are you saying there's no longer a supply chain issue, Phil? Last year, oil, lumber, whatever the case may be, raw commodities saw serious supply crunches due to logistical shutdowns all around the world from the pandemic. Is that still an issue?
No, not really in the U.S. We had a logistical issue when we just had that recent storm that went through Texas and through the Midwest, and that's why oil prices had some spikes on there. We had some significant drawdowns on the inventory data. In Europe, you might have some because of each company or country, operating independently with different lockdown restrictions. So there may be some logistical issues, but really in the U.S., we're starting to really open up. Once we open up that Canada border, the Mexico border, things like that, and we have more freedom on travel, you're going to see some of that demand pick up. But logistically, we won't have that anymore, any problems.
Okay. All right. Now let's talk about your positioning for the rest of the year now. For second half of 2021, how do you see gold playing out?
Okay, so the way I believe that the models that we have work are going to show that in the next quarter, you're going to see higher CPI data, record GDP data. And then after that, the comps year over year are going to compress, right? So how many people were shopping at Amazon last March versus this March? How many people were ordering pizza delivery last March when you couldn't go anywhere, that was your only option, to this March when restaurants are starting to open. So the comps are going to compress as we get more opening. The interest rates will start to compress with that economic data. At that point, we'll see the bottom in gold. So we're really optimistic on gold into the second half. Mm-hmm. So we'd like to be long silver, gold, and then we're also playing copper as a trading range. It's a infrastructure spending, bill commodity, and automotive sales have just done nothing but increasing in automotive demand is continuing to increase. And that goes into your rhodium, your palladium, and your platinum.
Can the rate of change for gold in the second half be as aggressive as last year's rate of change?
The problem with gold, the problem that I have with gold is that you had the mother of all,
yes,
it was the Super Bowl. It was it. And we got to 2,100 and some change.
Yeah.
Okay. So unless we have some new catalyst that could drive it at that rate, whatever it might be, it's possible that something happens. You have war, you have banning of currencies, you have perhaps maybe banning on the green energy guys go after mining and there's no mining. So then supply all of a sudden gets shut off, demand increases for gold, and you get the $2,500, $3,000 move. So I am optimistic there will be a recovery. I don't think we will make that new contract high, not this go around. I think it'll be a second. It's gonna be another multi-year catalyst to get us up to those record, the 2,500, 3,000 plus.
We'll follow up another time and talk specifically about potential drivers. Let's finish up the interview by talking about gold miners. I'm assuming since you're bullish on gold for the second half, you're anticipating gold miners to reach an inflection point soon as well?
Yeah, and I talked with one of my great customers, and he pointed out a few things, and it was really maximum pessimism. That's the thing that really got me on the miners. Even the conversations I have with people, they are so pessimistic on the miners. The reality is that interest rates will stop going up. So interest rates are a big input cost for miners. The energy costs, second biggest cost for miners. Those will come down once you have like Saudi Arabia and OPEC boost the demand. Gold prices should naturally rise with the compression on economic data. So I think that second half of the year, I think is a great place for the miners. And I don't recommend throwing in the towel because too many people have ridden it lower. I think you'll get that recovery trade in the second half. So, keep your chin up if you're long the miners.
Well, just one more point, since you brought up oil. Suppose oil continues to rally on the economic recovery, and you said earlier in the interview that some other raw commodities like oil has become a better inflation hedge than gold. What would happen to gold? Wouldn't people just move their money into oil and other commodities and away from gold?
No, because the demand for those other commodities will start to stall out. So if you look at lumber, okay, so say lumber prices, copper prices, things go up to this extreme number. Okay, what will end up happening? Well, we'll harvest more lumber from, deforesting. We'll also see a lack of demand because what happens if your $250,000 house now costs $500,000 because that's how much it costs to build it. The builders will stop building. The demand will shift out of those raw materials, and people will naturally gravitate towards different inflation ideas. And gold being at a bottom price, I don't know where the bottom's going to be. It could be 1650, something like that, 1600, somewhere I think we'll approach a bottom, and that would be your opportunity to get long for that second half.
All right, Phil, thank you so much for coming on today and giving us your update. We'll speak again soon on more market action. Thank you.
Yeah, you have a great weekend. Thank you for having me.
You too. Have a good weekend. And thank you for watching Kitco News. Stay tuned for more coverage.